A 1 minute cant.
Hey folks, what a view behind me. I'm at Black Bull Markets headquarters here in Auckland, New Zealand. Speaking of views, you can get TradingView paid plans for free at Black Bull Markets, saving you up to $600 a year. Get either the Essential Plus or Premium plans absolutely free. All you need to do is trade from one lot a month at Black Bull Markets. And you can also get a 100% deposit bonus for your first deposit up to $1,000. All you need to do is click the Trading Nut link in the description below. Our sponsor Blue Guardian's the only prop firm that gives their traders a tool to protect them from hitting their max daily loss and over trading. It's super simple to use. Just set the Guardian Protector each day from your dashboard. Did you also know that they've just released an unlimited time evaluation with a 0 trading days requirement, giving you plenty of time to hit their low 8 and 4% targets, making it super fast to get funded. Plus, it's cheaper than the 40-day time limit evaluation. Check out the link and coupon in the description to get 10% off your next Blue Guardian evaluation. Boom, here we are, folks. We actually made it on. It was not looking promising at the start there. I couldn't get on the screen. I couldn't share my screen. I couldn't get on the screen. For some reason, it all fixed itself as soon as this timer kicked into the live mode. So we've got myself and JJ here in the house. JJ, welcome to the Trading Nut live stream.
Good morning. Good to be here. Thanks for having me.
Yeah, look, I know it's early for you as well. So, folks, you're getting him at the start of the day. Hopefully it wasn't a big night the night before, so which I don't think it was. So we should be good here. Now, what we're going to do is dive into this presentation here and quickly run through what we are planning to do. Before we do that, though, can everyone hear us clear? So you would have heard myself, you would have heard JJ talk. Just put a Y in the comments for a yes. We'll just get a couple of yeses and then we'll dive into this. So let's see. We've got Wooden Bell has given us a wave, but we'll see if anyone's got a yes. Okay, brilliant. You can hear us both. Superb. Thanks, Topsy. Thanks, AP. John, Sparky. Brilliant. All right, folks. Well, what we're going to do in this, it's a Q&A with JJ. So we've had him on the show a few times. He's given us a lot of information to really sink your teeth into. You've heard his journey. I assume you've heard his journey and a little bit about him. And I mean, I'm here to sort of vouch for this guy's knowledge of the markets and how price moves is absolutely exceptional. And that's why I suppose people want to hear more from him, hear what he's got to say. So this is your chance to ask him some questions. So whilst we're going through this presentation, please have a think about some really good questions. We have actually had some questions come in that we'll go through as well. So don't stress if you haven't got any off the top of your head. But yeah, have a think of your questions. Chuck them in the comments, or sorry, in the chat, not the comments, the chat. And we'll get to those questions throughout the course of the show. So what separates winning traders? It's a live Q&A with us. So over the course of the show, you should be able to work that out. Now, let's go through this presentation here. So this isn't a sales pitch. There's no but at the end of it, we're going to sell you this XYZ. Nah, there's no sales pitch here. It's purely, we're just giving back to you guys just to help you get to the next level. We're going to do the viewer Q&A with JJ. So, yeah, if you've got your questions now, please chuck them in the comments. If not, we've got a few to get through anyway, so you're going to get to hear the answers to those as well. Then we're going to we had some real issues around screen sharing before, as I mentioned. So we're going to potentially do some key levels, maybe not these markets. Maybe we'll even get you guys to come up with some markets to work out which key levels are we're going to do. And it might actually have to be me doing the key levels and JJ giving the I suppose the expert's opinion on whether or not I got it right. We'll have to work it out because there is some sort of screen share issues here. Then we're going to do a free one-on-one live mentoring. So if we get 50 likes, folks, we'll do that mentoring. So what does that mean? Smash that like button on this video here. And what we'll do is if we get to 50, we'll go and check throughout the course of this. We will get one or two of you on here live and get JJ to help you out and give you some I suppose, free mentoring around your own trading. So, and finally, we've got a survey that we sent out. I put a link up here, and what I'll do is I'll chuck that link back in the comments in a second. That would be great if you could fill it out, and we'll do the results of the survey at the end of it. So this is really going to let you know where other traders are at, and are you guys still all struggling with the same kind of things? Or have you got different, are you're an outlier in a certain area? So you're going to dive into those survey results as well. So it looks like we may have had a question of a couple of questions coming already. So let's have a look here. What is this? Before we dive into, so we'll keep those questions on the back burner. We'll dive into our questions first. And let me get that survey link and copy that link. I'm going to need to copy it. I'll paste it in whilst you're giving some answers here, JJ. So, JJ, let's just dive into the questions. And that's probably the first thing to do. So let's do that.
Okay.
First question coming, and then we'll dive into your listener questions, watch your questions as well on live. So Andrew sent this question through to me. So I got a bunch of emails coming through, and this is one of the questions. So you go on about dynamic trading. Why is it better than what I can find for free on YouTube? So JJ, it's a good kind of question. Like, dynamic trading.
It is a good question. Why is it better than what somebody can find on YouTube? Well, what I've found over the years, I'm talking from experience myself, is that traders have a tendency to go to YouTube, find a strategy, and they think that's all they need to become a consistently profitable trader. When in fact, and you can look this up on AI, it's about the strategy alone is about 10 to 20% of actually what you need to become consistently profitable. I think traders that have been around for a little while, got a little bit of experience, have probably worked it out that the trading to become consistent goes far beyond the strategy itself. It's absolutely key to become consistently profitable, to understand what the other factors are and learn them and address them and combine them together so you can execute professionally, basically. What other notes on there could I add to that? To strategy with standard strategy. So it's 10 to 20% of what you're actually looking for. So the free content on YouTube is pretty much dynamic, but is generic. Sorry, but dynamic trading teaches you to adapt to real world market changes, which most strategies don't do. They're either like a trend strategy or a range strategy. You know yourself from building robots that robots struggle terribly when market conditions change. And that's such a huge part for new traders as well. They come to trading, they don't realize when the market conditions are changed. When those conditions have changed, they find themselves staying with their same strategy, taking setups and basically getting chopped up and taking a string of needless losses.
Okay, cute. Good answer. So, I mean, it is, I suppose, very much like YouTube. You're going to get the kind of generic, hey, here's probably what you want to hear. Whereas dynamic trading is probably here's what you don't want to hear, because this is the reality of it. And it looks like we have got a few good questions coming in. So we'll go through one more of these questions that were sent in, and then we might dive into another question that's coming through here. So Jason did send a question in. So if you don't use a mechanical strategy, how do you know your trade will go to target?
It's a great question. The truth is, nobody knows if their trade is going to go to target, and that includes me. I don't know. I manage my trades accordingly. I'm constantly, I'll paint a scenario. I've got a 50 pip target. Between my entry and my exit, there's going to be orders in the market, levels in the market that price needs to break before I can reach my target. I'm constantly identifying what those levels are in advance, and I need to see those fail, because if they don't fail, I'm not going to reach my target. So identifying those levels, waiting for the market to confirm it's broke that level, then I know I've got a very good chance of getting on to the next level that may be in the way or may not be in the way. And I do that until I either reach target or I'm actually stopped out of the position by managing my risk with my stop loss based upon these levels. So if it comes to a level and it's, let's say it's got 40 pips, it's moved 40 pips, there's still 10 pips to go to target, but there's still no guarantee it's going to get there. And I see so many traders let the market come back, gobble up all of their profits, perhaps, or even get stopped out, because the rules of their mechanical strategy just says, I'm not going to get out until it reaches 50 pips, or I'm not going to get out until it reaches 2R or 3R. When the reality was, there's so many barriers in front of that can make your trade underperform. I manage my trade according to what those barriers are. Is that
yeah. And look, I mean, I suppose one of the traders you're talking about is me, when I've done that before, and you've sort of noticed that I've done it where I've let it run. So I think the worst was something like 9R, and I let it come back to break even, and you're on my back for about 2 weeks after that. Right.
Yeah, I think everybody's got that story. Let me just add a little bit more into that, right? Just try to bear in mind that just because your edge was present when your strategy presented itself, it doesn't mean that your edge is going to continue to be present throughout the duration of the trade. Your edge can change in just one candle. So trade management, in my opinion, is where the money is made.
Yeah, it is so true. Look, there's a couple of good questions here now. The first one, I'm going to give you one that I think you're going to be able to answer pretty easily. And I know this is new to you. So this has come through from AP. So I think we've had a chat, AP, already. So you mentioned in the video that you have about 20 strategies. Why do you need so many? Is trading not about simplicity and sticking to one strategy?
Well, that's a really good question. Okay, I find the more strategies you got, the more tools you got in your toolbox, the more conditions you can deal with in the market, which means I don't have to wait very long to take the next trade. Do you need 20 strategies? Absolutely not. But if you don't have more than one strategy, you probably need to have the discipline to exercise patience, because it could be some time before your next setup actually comes around. And so simplicity comes with knowledge. It's not a case of I've gone onto YouTube, I've picked up a strategy, that strategy's got 3 or 4 rules. When those rules are met, I'm going to take my trade. Simplicity actually comes from knowledge. The more knowledge you've got about, should we say, reading price, reading the chart, the easier it becomes to place the trade. I'll give you an example. It was interested in in one of the questions of the survey. How many traders don't either know or check to see whether their setup is actually high probability or low probability? Just because the rules of your strategy have presented themselves and you have an edge, it doesn't guarantee that edge on this occasion is a good one or a bad one. And if you can't filter that out in the beginning, then you're compelled to take every one of the setups that presents itself, because you don't know how to identify whether it's low probability or high probability. When you've got 20 strategies or so to fall back on, you can employ any one of them at any time in any market condition. I've basically got a strategy just to cover just about any eventuality on the chart.
Yeah, and look, I'll be honest, it does take a while to really, I suppose, ingrain these into the back of your mind, and that's what you have to do, right? You can't necessarily trade JJ style without at least somehow breaking these strategies down into the back of your mind. So every time you see like a strategy form, you go, right, great, I got it. And at some point, it does actually work. You can get to that point where you do see the things happen time over again.
Can
Now,
I just add? Can I just add something
yeah.
into that? It's quite important, right? Well, you got 20 strategies there. The truth is, of those 20 or 25 strategies that I actually use, 90% of the rules for all of those strategies are identical. It's just the entry. That's it. So technically, I'm trading one strategy, but in 20 or 25 different ways. That's how I keep it simple. I need to keep it simple as well. That's how I do it.
Now let's dive into the next one. Great question, AP. Great question, mate. So we had another one here from who was it from? Jason. So Jason said, how do you deal with trading for hours and ending a day with a break even or a loss because runners may not come often?
How do I that's a good question. End of the day, break even or loss. Well, I would find it more difficult to start the day with a break even or loss than finish the day with a break even or loss.
But I think what he's meaning,
yeah.
sorry, I wonder if I think he's meaning if you trade throughout the whole day,
Yeah.
and you by the end of the day you're actually not just lose with it, you end with a loss. Your whole day was a loss, or your whole day was break even. You had some wins, you had some losses, you came out break even. How do you deal with that? I assume that's how you're asking it, Jason.
Yeah. Well, that's just a day in trading. You have to learn to lose before you can win in this game. So yeah, it might not be a good feeling to trade the whole session and find yourself break even or actually having a losing day. You come back, assuming you come back the following day or the following session, you're technically underwater from yesterday. You need to get a winner now to get back to where you were yesterday. And if you get emotionally involved with the trade, with a loser, you're going to have that on the back of your mind when you come back the following day. You're automatically putting yourself under pressure, and that's the last thing we want to be dealing with is the pressure of that. So the mindset when you come back is, look, it's a fresh day. That trade that you lost yesterday that caused you to have a losing day has got nothing at all to do with the next trade, and it never will have. They're separate events, and you need to treat them separately. This is a problem I think that most newcomers actually encounter. I did. I encountered this. Belief in your system. When you've got a big enough, when you've traded a strategy enough times, you've got a big enough sample size, and you can see that you've got a built-in equity curve. Then what we could say is, a war is not won by winning or losing one battle. You can lose a battle, but you can still go on and win the war. Trading is exactly the same.
Yeah.
Yeah. Go on. Carry on. Sorry.
I was going to say, in terms of like me and answering that question, because I just sort of thought, what do? I typically will go back and actually have a look at the prior day and go on, right, if I'd done this differently, done that differently, done this differently, then all of a sudden, like, my losing day would have been way better. And I was like, okay, great. Now I've got that knowledge under my belt that these are the things I could have done differently. I can start the next day with that in mind going, right, now I just need to make sure I do those things that I said I was going to do the day before.
Sure, that's journaling your trades. Go back and review them, right? I mean, it especially. I mean, I review winners as well as I do losers. Yeah.
And I was going to say, on top of that, I suppose that the benefit of this dynamic approach is the fact that you can actually do that. And whereas, like, I suppose if you've got a very mechanical approach and the setups just didn't work, then there isn't a lot of stuff you can do really, because it's like, well, those setups just didn't work. We're in a losing streak because that strategy had a losing streak at that point. Whereas with this dynamic approach, there's usually like 5 or 6 things you can chuck in there to go, well, why wouldn't I have taken that trade? Because of, X, Y, Z or whatever element you saw, and go, okay, well, that's a stupid. I shouldn't have taken that trade because of this. Would you agree with that, JJ?
Yeah, absolutely. Because having a dynamic approach helps you understand over time the elements that make your trade go wrong. You get a setup. You can't identify whether it's a good one or a bad one, so you take the trade. let's say on this case is a bad one. You get in, it moves a few pips in your favor, and you get stopped out in the next candle, for argument's sake. You know, you're left scratching your head. Most people just say, well, I have to put that down as one of the losers, and they move on. It's you know, the rules of the strategy are black and white. It doesn't teach you these elements. It doesn't teach you how your black and white strategy will never teach you what, you know, when it's a good high probability setup or whether it's a low probability setup. That's it. And you have, so yeah, they basically have to deal with it. The dynamic approach helps you to learn to recognize the factors that can make your trade go wrong. And now, obviously that's great for your equity curve.
Yeah. So, we're going to dive into another question here. So this is from Shaba. Before I get it up on the screen, folks, remember, if we get to 50 likes, I haven't checked yet, but if we get to 50 likes on this, we'll get 1 or 2 of you coming on here for a live mentorship. So we're actually going to help you out. So let's have a look at the next question. So smash that like button if you haven't done that already. So Shaba Ranks says, and now I'm throwing this one at you, JJ, because I don't even remember you saying this, but he says, you mentioned that on 1 minute looks on the 1 minute looks to play the waves. How are you deciding which wave to play so you don't get chopped up? Do you actually mention that on the 1 minute? Yeah.
That must have been the scalping video that I recorded on a 1 minute.
Oh yeah, that would be it. Yeah.
What Shaba is referring to here?
Yeah, it must have been.
How do you decide what waves to play so you don't get chopped up? Well, when you look at a chart, any chart, it doesn't matter what the time frame is, what 1 minute on that particular day. If anybody's watched all of the video, I wasn't actually trading levels on the 1 minute chart. I was trading levels on a higher time frame, but the people were viewing a 1 minute chart. Basically, to answer the question, you have to have a reasonably decent understanding of where the orders are placed in the market. You know, when I said take a look at a chart, a 1 minute chart, it's constantly, you know, in theory, it's constantly painting 2, 3, 4 candles of one color, and then it changes direction and it paints 2 or 3 or 4 candles in the other color in the other direction, and that's how the day, you know, literally plays out. It's the markets are constantly in motion and constantly changing direction. What makes it change direction? Orders. That's exactly the market. Wherever you see that a market stops and turns or goes the other way, it's because there was orders there. You don't need to know the reason why they were there, but the fact that they were there. When you can recognize them, then you can navigate through the waves and not get chopped up.
Yeah. So it's knowing where the orders sit really is, and that's one of the skills that JJ has. Now we've got another question here from Jason, which was, how are you using the larger timeframes, in particular the individual candles, to play the lower timeframes, or are you looking for patterns on higher timeframes?
My trading focuses on levels on higher timeframes, but I don't actually trade them on those timeframes. I trade them on a lower timeframe. So I identify high probability turning points. You know, from a whole, I use a whole different huge toolbox to identify these levels, and they're literally everywhere, all over the charts. So and I think this is, if any new trader can aspire to trade this way, there's a real huge advantage, not just psychologically, but also in your equity curve, you know, and making profits. When we're a novice trader, I'll answer this question directly in a second. When we're a novice trader, we're going to make mistakes. I still make mistakes. I just make few by comparison to where it was when I first started. Okay, you need to have a profitable P&L. When you're new, you know, you're a novice, you're learning to do this. Those mistakes eat into your profits, and they can affect us psychologically. Making those mistakes, discipline, you know, we kick ourselves, all the reasons why we make these mistakes, but the point is they take your profits away. Okay, so I think it's quite important that when you can get in a trade with a high R or a multiple R situation. So if you get, let's say you make a mistake, you take a loser, and then your next trade is just a loser, but then your third trade is a 3R trade, then you've made a profit. But you've only won 33% of the time, but you still made a profit. Rather than ending the day, as one of the guys said earlier, ending the day where you're down or you lost. Yeah. So aim to find higher time frame levels. This is very important, and trade them on a lower time frame. Because if you get a small bounce, let's say on a 4-hour or a daily chart, that's going to be a sizable move down, let's say on a 1 minute or a 5-minute chart. So if you can time your entry at these levels, you can have a relatively tight stop loss. And now you have a good chance of your trade becoming multiple R.
There's in it further to that question, Shaba's asking, like, if you look to trade levels on a high time frame, does it not mean we have to wait much longer to trade for a trade to show itself, hence less opportunities on the 1 minute?
No, absolutely not. Because let's take it. Let's say you're trading on 1 minute. Because it is, I mean, for those who can manage to trade on 1 minute, it's a fantastic place to trade. Because you can get multiple R winning trades relatively frequently, quite frequently, in fact. Okay, but you don't necessarily have to trade them with 1 minute levels. So let's take a look. You're trading, let's say 1 minute. You trade in the 1 minute. Okay, you can look at 2 minute levels, 3 minute levels, 5 minute levels, 10 minute levels, 15, 30, 1 hour, 2 hour, 4 hour. And when you're doing that and you're identifying the same levels across the different time frames, so you're training your brain, if you like, to focus on the same levels no matter what the time frame is, then suddenly you find yourself with countless opportunities throughout a trading session. However, I think where he might be coming from here is if you were going to say do that on 1 4-hour chart and wait for 4-hour levels, then you're not going to get to trade much that day. So learn the levels and apply them across multiple time frames and trade them on your 1 minute chart or your 2 minute chart or your 3 minute chart. That's how you get around that.
Another one from Shaba here. So can you give us some examples of strategies you utilize? Now, there is actually one on the channel. So if you do hunt back through the videos, you'll be able to find it there, Shaba. But really, I mean, the funny thing is, JJ, you're kind of one for, like, you don't really want to give people stuff for free because it's almost like, I mean, for you, it's seen as like the easy way out, isn't it? For people,
well,
they just
I was brought up in a family where I was taught at a very young age that very often when you give something of value away for free, it's not appreciated, and we kind of proved that with the beta testing, where we put a lot of hours and effort into the beta testers, and we give them a set of rules, and they just basically done what they wanted to do. When it comes to answering questions like this, I got no problem with helping people and guiding people. Okay, I got no problem with giving information that fits in with the retail side of trading. Okay, when it comes to institutional level, that's when if you want to learn the institutional side, I'll teach you, but it will never be for free. Not from the institutional side. What I'm talking there on the institutional side is anything to do with limit orders. I don't mind showing somebody a stop order strategy, that a reliable stop order strategy that they could, that they can trade at home. I don't have an issue with that at all. Yeah, but when it comes to the institutional side, no, that's I'm afraid that one will always be behind closed doors unless somebody is prepared to give something to obtain that knowledge. And if they are, then I'll be happy to share that knowledge with them.
Yeah, especially, I mean, I suppose it's a reason why we've got this 150K mentorship giveaway that's linked below the video here, and that's why it's valued at that much. So if anyone's wondered that, Right, let's have a look. There's probably a couple of other questions in here. So, Uma, those can be found on Google or ChatGPT. Just type them in, you'll work out what they are. That was enlightening from Shaba. So great that it's enlightening. That's it for the questions at the moment, folks. Do remember, smash that like. If we get to 50, I don't know where we're at the moment. Then what we're going to do is actually, let's see where we're at. We're going to get one of you on here to do a bit of one-on-one coaching with you, or maybe a couple of you. See how much time we've got left. And also remember that survey. I'm just going to chuck the link back in to the survey, and we're going to fill those. We're going to reveal the responses. Fill in the survey. I'm just typing here. Let's fill in the survey. So yeah, we're going to fill in those. Reveal the responses here at the end of the show. So because the questions are slowed down a bit here, what we're going to do is dive into some of these other ones that we've got. So I'll share my screen again and go from there. So Zero was the next one.
Okay.
Why can't I just stick to one proven strategy that works all the time instead of being dynamic?
Well, the simple answer really to that, and it's not a difficult one even for a novice really, is that no single strategy works in all conditions. You know, when you're, I try to put an analogy to that, you know, when you're driving your car, you drive in a much more, you know, you're much more aware. You're driving in when it's raining compared to when it's dry. You know, you put your wipers on. Okay, it's different conditions. So you act according to those conditions. Strategies that have hard and fast rules don't adapt to the changes in the market conditions. And I know from experience, and you can AI this yourself. Ask ChatGPT how much of an issue it is for new traders to realize that the market conditions have changed. It's easy to say after the event, oh, look, you know, we went from a trend to a range. But how long does it take you to identify that you're actually in the range? You probably don't even realize you're in a range until it's starting to be well developed. But you're trading a trend strategy in a range and you don't even realize that you're in a range. And it doesn't take more than a handful of candles to actually realize that you're in a trade. So you don't need a big channel with 30, 40, 50 candles
in a range.
There, yeah. Yeah, in a range. Yeah.
In a range. Yeah.
So adapting to market conditions is absolutely essential. And it's one of the biggest problems that traders actually encounter. Even professional traders, institutional traders, they struggle also. It's right across the board. So if you're employing a trend trading strategy, but the market's actually progressed into a range, then you're going to get beaten up. You're going to start to take probably a string of losses. So that's it. You need it's what's the old saying? Horses for courses. Okay, trend strategy, trending markets. Range strategies, ranging markets. My number one question that I always have to answer before I take a trade is, what are the market conditions right now? If I can't answer that, I have no business placing a trade.
Right. Great answer. Great answer.
Okay.
Yeah. We had a few more here. Jasmine, so she was asking if I'm a beginner, isn't it better to follow a fixed system before trying to be dynamic? So take the simple route first. Is that better?
It is to dip your toe in the water, right? When you're new, everybody's keen to. I was as well. To you know, when I look back, skip the learning and let's get in and trade. Let's see if I can do this. And what? So you take a fixed or a rigid system strategy, and you, like I said, you don't know when the market conditions change. So is that good? No, it's not. You know, but when you're flexible or you're dynamic, you change you apply a different approach that could and a different form of a strategy. I'm still looking for the same things. It doesn't matter what the strategy is. I'm still always looking for what's going to make my trade go wrong. So I identify levels. I'll give you an example. I'm about to go short, but the next level is only 7 pips away. But my stop loss for this trade needs to be 14 pips away. That's not a very good risk to reward. And there's a strong chance that the market is going to hit that level, bounce back up. It hasn't got to go very far to stop me out. I don't want to be trading on top of support and resistance. I want to be trading far enough away from it where I've got a good chance of hitting 1R, 2R, 3R, or my target, wherever my target is. So fixed and rigid systems are great to start off and dip your toe in the water, but they don't allow the trader to develop and move on to the next stage of trading, because they're not learning anything about the market. All they're looking at is the chart. They're waiting for the rules of their strategy to be met, and then they take the trade. They don't, so they're never progressing. When you're being dynamic, it forces you to ask the question, what's going to make my trade go wrong? Who does that? A professional trader is going to do that. He's going to look at the chart. He's going to say, right, okay, it's risk. What's my risk here? Okay, it's 1%. That's fine. But what's the probability of the trade? And what's the return on the trade going to be? And will that outweigh the risk? So I just let me just reiterate just one part there. Start with a rigid and a fixed system, because it does give you some experience in the market. But don't ever expect that fixed system never to go through a string of losses. That is guaranteed to happen. An extended string of losses, 4, 5, 6, 7, 8 losing trades in a row. And I don't know many traders. In fact, I don't know even if I know any that would struggle to take the 4th trade if they've just had 3 losers in a row. And that induces strategy hopping. They don't want to go through the pain of the drawdown and the string of losses. So they start to strategy hop, believing that the answer to their success or their problem lies in a new strategy. It doesn't lay in the new strategy. You're going to encounter that string of losses, whatever strategy it is that you employ. And that should enforce the need to gain knowledge so you can pick the best setups with good risk to reward. And when you can do that, as I mentioned earlier, across multiple time frames, you don't have to wait very long for a trade. It is not difficult to trade 20, 30 times a day or even more if you know what you're looking at. And I mean high probability setups and using limit order setups, not just stop order setups. With stop order setups, which is what most retail traders do, they're actually chasing the market. You get in the move late. Institutions just do not trade it that way. They trade with limit orders. In other words, they jump in front of the market. They want the market to turn around pretty much where their order is. So for argument's sake, Joe takes a trade. It's a stop order. He's got a 7-pip stop loss. That's fine. I might have a 7-pip stop loss. But he's in 7 pips after the move is started. I'm in 1 pip, 2 pips after the move is started, or exactly when the move is started. So I might have the same stop loss. By the time he gets to 1R, I'm already at 2R. So it's factors like this, being dynamic and applying knowledge permits you to do this. It reduces your risk and it increases your reward.
Great answer. We've got a couple of another good questions in here. And just on that answer, I mean, if you guys saw the video about breakouts, you would have seen JJ explain exactly how that works, right? So that video didn't get that many views, but it was exceptional. And you can see where he's getting 2R and where everyone else is getting 1R, right? So anyway, let's dive in. Shabad's got another question here, which was let's go through it here. Do you average down on trades with multiple ads, and do you use a stop in that scenario?
Yes,
So
I will average down, but only when the market is in a range. I would add to a position that's in a trend, but I've got a hard and fast rule on that. I'm going to make sure that the risk of my first position is negated. In other words, my stop will be at least break even, and then I will add to that position. Okay, that's much easier than actually, psychologically speaking, than actually doing it in a range. When you're in a range and you recognize in your range, and let's just say I'm talking probabilities here. When you're in a range, you've got about, on average, 3 or 4 bounces. It's often, a majority of the time, it's going to be 3 bounces off the top of the range and 3 off the bottom, most time. And then it's going to look to break out. So it'll touch the other side technically a 4th time, but push through. Okay, so when you know that, you can say, okay, right, it's only touched twice. Well, the chances are now this range is going to continue for at least another 1 touch either side. Once you know that, then add into technically, averaging down. You take a position, you're in a trade, you're taking heat on that position. You're not actually making money. You're underwater on that open position. Okay, and then add to the position. It's why? Because you should go back. Probabilities say you're going to go back to the other side of that range. And what eventually will show on your P&L is, if you're trading in a range that day and you're doing this, you may have only a 60% win rate. That's what your P&L is saying, but you've made good money that day because your winning trades are swallowing up your losing trades. In other words, you're technically trying to get at least a break even by adding to the position. But very often, your add-on will actually go and produce you a profit. That in range trading is fine. And yes, I do that.
Cameron Stitchbury asks, so you talk about the importance of trade management and ongoing watching of candles as part of this. Can you please elaborate and or provide an example?
Okay, I can elaborate on that. Okay, let's say the easiest way to do that is just, picture a trend. A trend. We all know what a trend is. Let's assume it's a downtrend, a series of lower lows and lower highs. Okay, the market pulls back, you jump in. You get yourself set up, you jump in. Where's the next? Where is the obvious place on the chart that the market may have a battle with? It's going to be the low, or close to the low, or a trend line off the low. It might be slightly higher than the low. It might be slightly lower than the low. It might be at the low. But that's your problem. That's the potential problem point. So when I'm taking a pullback setup like that, and I'm in, and I might be at 1 or 2 hour or something already, I need to see that level gets broken. Okay, if that level gets broken, then that becomes resistance. If the market pulls back now, there's a reasonable chance that resistance will hold and the market will go further down and make a lower low. And you just keep repeating that process. Now, if you're using multiple time frames, let's say it's a one hour a trend, and you're looking at a 4 hour, or you're looking at a 12 hour, or you're looking at a daily, you can pick levels off those higher time frames also. So you're trading down on your 1 hour trend. Don't just look for levels on the time frame that you're trading. Look to see it pass in and close in beneath levels on other time frames. Because when that happens, that's when your limit order traders are going to step in and place orders there. So if the market does come back up, they're going to try and push the market back down, obviously in your favor. Okay, so it's technically support and resistance. when, in this case, support is broken, will become resistance. And you just keep doing that. That's how I manage my trades, okay? I want to see it constantly break support, that support to become resistance, and then I'll go on to the next one, and so on, all the way down until either I hit target or I exit the trade, or let's say the market now makes a double bottom, and that's a signal for the market to go up. That might be the time to take some profit. There's different techniques. So identifying levels in the market is absolutely essential, in my opinion, to highly effective trade management. And remember what I said earlier on, trade management is where the money is made. The money is made on your exit, not on your entry. And it's your trade management, if you're good at it, is going to determine exactly where, good or poor at it for that matter, it's going to determine how much money you make, where your exit's going to be, and what profit or loss you're going to realize. So having an understanding and knowledge of where the levels are will help a lot, a considerable amount, with your trade management. So if I could give any advice based upon that, study the charts, find levels that you can identify over and over and over again. In other words, they're reliable levels that you can rely on. And when price passes them, you know the probabilities are greater now that your trade is going to give you a better reward. That's, it takes time. Again, that's that knowledge thing, right? Does that make that extra knowledge make your trading difficult? No, it makes it easier, because you're using evidence that you see on the chart to make your decisions. You're not doing it from emotion. You know the reason why you've tightened your stop loss up or you've taken partial profits here. Not just because the rules of your strategy just say, I'm going to take half, 50% of the position when I get to 2R, and I'm going to let the rest run. When you say, okay, that is fine if every one of your trades you're taking the market is in perfect conditions for the rules of your strategy. And we know that's not the case.
I'll tell you a little secret, folks. I struggled with doing exactly this, which is watching those candles unfold. And I don't know what it was, some psychological thing where I just didn't want to. I was basically too lazy. I was too lazy to sit there and watch these candles like tick over one by one. I wanted to just be lazy and go, right, set a fix, take profit, stop loss, whatever happens, happens. And so many times the frustration just sort of drove me up the wall to the point now where I will watch the candles, right? And once you do start doing it, it actually becomes way easier, and you start to go, well, why was it such an issue in the first place? So there's
I tell you what we do, right?
Right?
Shaba's been good enough to chuck a whole bunch of questions in here, right? We can do a video on that, and I can show an example of that for the future.
Okay, right. Managing the trade and
managing the trade and show it a visual example, because I know that's going to be better than an oral example which I just gave.
Yeah.
So Shaba, we'll do that for you, and we'll get one up. We'll get one up on Cam's channel.
Okay, cool. Well, that was Cameron asking that question anyway. But
sorry.
Yeah. But Shaba has been good. Jason had another one here. What is an institutional level that is not support and resistance?
They're all support and resistance when you think about it, right? And it's
I think what he probably means is horizontal support and resistance.
So what is an institutional level that is not support and resistance? Okay, right. It's technically a little bit vague in the question. Okay, so I'm going to try and answer this as best as I can. So all support and resistance is where orders lay in the market. That's all support and resistance is. So look at support and resistance of any type as orders, because for your support or your resistance to work, there has to be orders there to stop the market going in that direction and turn it around and make it go the other way. And when that happens, you say, oh yeah, my support worked or my resistance worked or whatever the case was. If there wasn't enough orders there, it wouldn't be support or resistance, because it would just go through with ease. So what it might be a perceived support or resistance, because that's what your analysis told you, but it doesn't mean that it was actually going to be support or resistance when it got there. Okay. Now, one, and I think I'm answering the question. This should be good enough on this. Okay, let's take a measured move. If anybody doesn't know what a measured move is, then basically we measure a leg. Let's say it's a downtrend. You measure the first leg. We come down. We make a lower low. It pulls back. Measure from the top of that leg, from the start to the low, and then whatever that distance is, add that distance from the start of the top of the pullback. And that's what we call a measured move. Now, what's likely to happen with that measured move is there's going to be a load of orders there to exit positions. And that might not marry up with any obvious support and resistance level that you'll see on the chart. In other words, it's like a dynamic support and resistance. A bit like a moving average can act as a dynamic support or resistance. And when you got institutions exiting positions, at the end of a measured move, then in this case, if it's a short, the market is likely to bounce back up. Once you know that, you can say, okay, this is where they're likely to exit. Great if it marries up with something else on the chart where you get confluence, but if it doesn't, that's still tradable. You can trade their exit now. So when they exit, their exits are going to push the market back up. That's when you're looking to go long on your lower time frame. So look for some price action that you understand. Don't just say it's going to happen, because you don't know it's going to happen. What you can do is you can take some information off your lower time frame and add confluence to that higher time exit level. So that's support and resistance that is not obvious on the chart unless you're aware of like a measured move. Understanding where institutions exit the market, it to me is equally as important as where they enter the market. I hope that answers his question.
Yeah, I think it does. Yeah. So AP's got another one here. So when using a trend line, they tend to be subjective because price can go to sharper angle line than the one we first drew. Do you look for multiple confluences for trend line rather than trade single trend lines?
I don't look for multiple confluences in trend lines. I think there's a misconception, right? Trend lines, let's be clear. Trend lines is a can of worms. Okay, it's a can of worms because, as he says here, he's put the word in subjective. Subjective means, well, how I draw a trend line might not be the same as the way you draw them, Cam. We can draw them. You could draw your. It's the same chart. We're looking at the same data, but you might put yours on there different to mine. And a misconception that I learned relatively early on, and to overcome the reliability of trend lines, because many people out there say, oh, they're unreliable. You got others that swear by them. Myself, I swear by them. They give me so much guidance from an institutional point of view. But I've got lots of practice actually, drawing them, and I draw them in specific ways. So the misconception is this: oh, wait for three touches. The more touches of a trend line, the better. That's untrue. And I'll tell you why it's untrue. It's because when you get a trend line, they're usually very reliable for the first one or two touches, possibly the third touch. So the more times it touches it, the more chance it's got of failing and actually going through. So I developed a system where I could actually take let's say a high or a low on the chart to make it easy, or the top of a pullback, something like that, and I would draw a line from there into the distance. I no longer need two anchor points to draw my line. Okay, but I still do use 2 anchor points to draw my line. Okay, so when he goes on here to say that you draw your first trend line and then it gets a sharper angle. Okay, there is a way of dealing with that. So basically, technically, what he's got at that point now is, if it's a down line, he's got 3 highs. The high where he started his trend line from, the lower high which gave him his second anchor point. Okay, and then the market probably dropped down quite aggressive, and then gave a lower high that didn't come back to that trend line. So just draw a trend line from the second high to the third high. That's a new trend. That's a new trend line in itself. Try that. And also, there's 2 ways of actually drawing trend lines, 2 basic ways, without getting into anything deep and technical. Trend lines don't just work off the highs and the lows. They also work off the closes of the candles. Have a practice, okay? Have an inner and an outer. So let's say in this example, where his first anchor point was the start of the move at the top, okay, and then he gets his second anchor point, and then he draws his trend line and he links those 2 highs together. Duplicate that line. Don't change the angle. Duplicate it and put it on the close of the candle, the first candle. Yeah, I mean, assuming that the first candle that he put it on was a bull. Let's assume it was a bull. It was like a bit of a weak bull. It's got a bull with a wick on the top. That was his first anchor point, right? Just duplicate that line, and it's basically, now you're going to have an inner line, but that inner line isn't starting from the high. It's starting from the close of that candle, and watch how the market reacts to that. And you can trade off that, and you can trade off that very effectively.
Yeah, it is true. You do trend lines different than me. I actually do use the close way more than anything else.
I use the close way more than the highs. I still use the highs, but I do use the close more than the highs.
I mean, I did a live stream earlier this week, folks. If you want to see about 1 million trend lines I drew in about an hour, and how often you can draw them. Right. Next question we've got here. I haven't read this one in full. The Dreaming Trader. Welcome, Dreaming Trader. Multi-time frames trading causes conflicts, e.g. trading with the direction of the higher time frame often means there is no setup for a long time on a lower time frame during a good-sized pullback, e.g. on gold.
Yes and no. What's the point? Why do I use higher time frames? I use them for confluence. I don't use them for conflict. So I think what you've got here, let's say, is the 15-minute is in a downtrend, but the 4 hours in an uptrend, or the daily's in an uptrend, right? Okay, that's I'm only assuming here that's where the questioner is actually coming from. I think
right? So.
Yeah. So then you've got conflict. Okay, so if you're looking for confluence, don't be going short. Go long. Go long with the 4 hour. You wait for your setup on the 15 minutes, but you go in long in conjunction with a higher time frame, right? So that's confluence. Okay. Now it becomes a lot more exciting when, let's say, the 4 hour is trending up, and then you look for bounce levels on that 4 hour. You can look for bounce levels on the 1 hour, on the 15-minute, the 10-minute, the 5-minute, as long as they're all long. You go in conjunction. Okay, that's how you get over conflict. Don't even enter into conflict. Recognize it, but don't try to challenge the conflict. Okay, I have a rule for that I've had pretty much since my very early days. Is if I have conflict, in other words, if there's one time is it's saying up, the other time frame is saying down, where am I going to put my weight? Where's the weight going to go? It's always going to go on the higher time frame. If you want to know where the lower time frame is going, ultimately, you need to understand where the higher time frame is heading. You're never really going to effectively, in the long run, going to be able to tell where the 5 minute is going? Buy information on the 5 minute chart. Yeah, you can have a double top, you can trade it, you can short, you can do all that kind of stuff. But the overall underlying direction, you get that from the higher time frame or the higher time frames. So if there was conflict, and that conflict says to me, right, I can't identify an edge. And I think that's in part where he's coming from. If you can't identify an edge, you have no business taking the trade. Stay out of the market. Find that edge. Trade in conjunction with a higher time frame. Take a lower time frame entry to maximize your risk to reward.
And I suppose the other thing that just think about Dreaming Trader's question there. I mean, if like being dynamic just means that, you know, if JJ's example was like the 4 hour chart and the 15, right? So being dynamic means you could, if you wanted to, probably go, well, yeah, the 4 hours in an uptrend, or maybe the 4 hours in a downtrend. Sorry, the 4 hours in an uptrend, the 15 minutes in a downtrend. But then you can look to go, well, maybe I trade the 4 hour uptrend or the 30 minute. There's a 30 minute uptrend, and get it on a 5 minute or a lower time frame like that. So I don't know if I'm explaining it very well here.
I think so. I think I get where you're coming from.
Yeah,
you don't always have to go up.
Yeah.
If the market's coming down, yeah, if the market's coming down on a 15 minute, but the trend is up on a 4 hour, it's probably not likely to come down all that far, right? You might get a couple of pullbacks. You might get a mini trend on the 15 minute, for argument's sake, okay, or the 5 minute. But there's a strong possibility that trend isn't going to go on that long, not unless there's a complete reversal in the market. So referring, say, to a trading on a 15 and referring to a 30, that's fine. You can do that, a 30 minute. You know, you can look to the one just above it. You know, but just don't be mindful of the overall strength in the market and where it lay. You know, in which direction it's actually going in.
Yeah, I think a better example I was thinking was like daily and uptrend, hourly and a downtrend.
Mm-hmm.
Within that day, you could probably go and be dynamic and go, well, hours, like I'm looking for a down move in the next hour, instead of worrying about the daily that's in an uptrend and going, well, I can't take any trades because I'm going against the daily. You go with the hourly and take an hour trade on a lower time frame. So maybe you're in the 5 minute, 3 minute, something like that, and you take a trade on that time frame. With your, I'm only going to trade a shorter period of time. I'm not sticking around for the next 2 days because I think the daily's going to be in that trend. So you're going to get in and out. That's probably how I would do it. So you're not having to wait as long. And in fact, I did that yesterday or the day before on that live stream. I was like, well, I mean, I'm not even looking at really not caring what the day's doing. The day's almost closed as a doji. And it was like, but the hour's telling me this. The 4 hours, I got nothing on the 4 hour. So I'm going to trade the hour and try and get a trade off that. Now, guys, we've got 22 likes here. We're looking for 50 to get somebody on here and do a special one-on-one thing. So we got to smash that like button if we're going to get up there. So if you're watching, then please hit the like button or share the stream. And we'll see if we can get to that 50 mark. Righty-ho, next question is, let's just hide this one, from Tom R. So Tom says, is dynamic trading in a nutshell discretional adjustment of your strategy based on experience on what you are seeing develop?
Yeah.
So I think
absolutely.
Is it really discretion?
Is it discretion? No, not necessarily. Let's go back to the example of where I'm looking for levels. I'm in a trade and I'm trying to get to target. And I need to see it, we're talking about a short. I need to see it, constantly break support and close on the other side of support. That's not discretional. That is using the information and the evidence on the chart to help me understand what the probabilities of getting to target, or should I get out, or should I take some profit. So it's not discretion in that part. My decision making is based on evidence. It's not based on gut feeling, you know. So I can understand why the question, was being asked. Yeah, adjustment is dynamic, right? The markets are dynamic. When you think the markets are constantly in motion and they're constantly, you got all these time frames. There's a constant change of conditions going on. You might be in a downtrend on a 15-minute chart, but it could be going sideways on a 1 minute. So there's all these conditions, constantly changing right throughout the day. That's dynamic. You go with that. Be dynamic. Go with the markets. If you're not dynamic and you're rich and you're not adjusting, then you're not being dynamic. To me, it's like swimming upriver. You're actually battling rather than joining the battle and going. You're going with the ones that are winning the battle. Okay, so discretion. No, I can't say there's not times I don't use discretion, but usually all my decision making is based upon what I see on the chart, what I call evidence.
And look, I mean, I'll give you some examples. Like there's been a couple of times where I've like drawn up levels that I've expected rejections from and stuff on the chart, shared it with JJ, and he's like, I've got exactly the same levels. He's sharing the same screenshot back to me. So these are like, it is a mechanical way of being dynamic. I think the only probably discretion would be on trend lines and how you decide to draw your trend line versus, because there are so many of them, right? You could draw like 1 million trend lines on a chart. So that would probably be the only kind of discretionary thing that you would be doing. But every aspect down to every strategy is literally pixel by pixel on the chart, mechanical.
Yes, yeah, definitely.
But together, it becomes dynamic reading of the market.
Yeah. Wait, there is one little area of potential discretion. I'll just give you an example. You might call a candle a doji. I might not. In other words, somebody's idea of a doji might be a very, very small body and more or less equal wicks, upper and lower wicks. If you got one of those wicks 50% longer than the other wick, some people might call that a pin bar. So there could be a little bit of discretion around that, what a candle can be on occasion. So how do I deal with that? If it looks like a doji, treat it like a doji. If it looks like a pin bar, treat it like a pin bar. You do get textbook ones, but often you don't get textbook ones. So this can be a little bit of discretion, but I think that is quite sort of easily overcome having spent time in the market. Just time would help with that.
And I suppose the other thing we've talked about before, you mentioned to me way back in the day, is broker difference and the fact that
true.
You're going to see one broker's going to show this candle and another's going to show a different candle, which happens. I mean, geez, we saw it today, right? When we were looking at charts today, we were like, you couldn't see the same thing I could see because I was on a different kind of chart. What have I done with my chair here? But anyway, all right. Now, folks, we're at 26 likes. We really need to push those likes if we're going to get to this person coming on. So we've got a few more questions here, JJ. I don't want this to go on forever because I'm going to have to leave at some point, and
sure.
I'm sure other people have got stuff to get on with. Let's have a look at the next one. So Shabba's again, so how do you psychologically train your mind to trade when you see trade what you see on the charts versus having a bias of where you think it will go? Psychologically, how do you do that?
Practice, repetition, and belief in your system through the repetition. I constantly say to anybody that I talk to about trading, and I'll be honest, most people, what I'm about to say, I don't know anybody that's actually seen it through. and that includes yourself. So repetition is absolute key. Let me give you an example. When I look at a chart, I'm not looking for specific things. They find me. It's like when you drive a car. Let me give you an analogy. When you're learning to drive a car, it's mentally tiring, right? It's psychologically taxing, right? When you're driving. Once you've driven for a period of time, you pass your test, you're out, you're driving. Yeah, you suddenly everything you do becomes second nature. You don't think about putting your foot on the brake or accelerating or putting the indicator on or checking your mirror or jumping on the brakes when a dog runs out in front of your car, for argument's sake, right? These are things that you all do natural, but largely much of what you're doing when you're driving is visual. So you're doing it without thinking about it. And to get to that standard, you have to do it enough. You couldn't do that when you first started driving. You had to drive enough to be able to learn to do that. So when you train your mind, you actually trade, in my opinion, your subconscious. Repetition programs your subconscious. So when I now look at a chart, all the things that are important to me jump off the chart at me. I don't need to go through a checklist or anything at all like that to find them, like I may have had to have done, or I did do right in the beginning. I used to write a checklist and actually stick it on the side of my monitor to make sure that I checked for, X, Y, and Z. I don't do that now. Okay, so from a psychological point of view, it's much, much, much easier because I've seen it countless times. I have a firm belief in what it is that I'm looking for. And I know and I understand its edge. And I understand when that edge dissipates. So I know exactly when the optimum moment is to actually enter a market, exit a market, get out, because I realized that the trade just isn't working out, isn't going to work out. I make my decisions again based on evidence. I'm not doing it from where I think it will go. If the market is going there, it will tell me it's going there. It will show me it's going there. It will pass those barriers that I'm talking about and get there. I'm never trying to second guess the market. Therefore, I don't have, psychologically speaking, I don't have any internal conflict. I hope that kind of answers the question.
Yeah. Next question from Jason again is, so say the 30-minute chart was in a downtrend and hits a level and the next candle is green with a bounce on a 1 minute, it will look like it has a big uptrend. So would you short that or long it because the new 30-minute candle might be green again? I'll go back to the original question. So basically, you got a downtrend, you got a bear, you got a bull that's just confirmed. Would you short it or long that? So
it hits the level and the next candle is green. So if it's hit the level on the 30-minute chart and the 30-minute candle is now green, okay, so that means obviously it's bouncing up from the level. Okay, so if I'm down at that level, I would be down. I'd be waiting for the market to come and touch or get very, very close to that level, because I understand the broker differences. And I would be looking, if you like, to go long or with confluence on a lower time frame. So it's green. Then with a bounce on 1 minute, it will look like it has a big uptrend. So you would short that or long it. Well, what have you got? If the 1 minute's gone into should we say, a trend, which is quite easy for it to do when it's bouncing off a higher time frame level, then trade that trend. For the market to go back down, that 1 minute trend's got to fail. It's got to reverse, right?
Yeah. So
it has to reverse. Yeah, I'm not.
I think that, because what I'm picturing in my mind is like, so on a 1 minute it's gone like strong down, then you've got a big bounce back up, other direction. Can't do it
Yeah.
in here. Other direction back up like a tick. And now, so you got on the 30-minute, you got that red and then the green's closed. Would you short along there? And I think like on a 1 minute, the move's already happened. So you're probably not going to be getting in, right?
Right.
Versus
This is where this is where I think the question is it can potentially have two answers, right? Because what he's talking about is a green candle, right? It's a bounce and it goes green.
On the 30.
There's a difference between a green candle that's printing and a green candle that's closed.
Yeah, I believe it's like in it longer because the new 30-minute candle might be a green again. Okay, yeah. So you don't really know. So it's basically that's the answer, isn't it? The candle hasn't closed yet, right? So
well, if the candle isn't closed, then you trade in the 1 minute, all right? And as long as that 1 minute trend conditions are intact, in other words, higher highs, higher lows, okay, trade that 1 minute, okay? But the moment, assuming now that was like a pretty strong move down, should we say, on the, or it's a trend move down on the 30-minute as opposed to a range, then when that 30-minute candle closes as a green, I'm definitely not going to be looking to buy. So if I'm not looking to buy, what am I going to be looking to do? I'm going to be looking to sell.
Yeah.
So which is counter to what most of your retail traders would think. In a situation like that, when I see a bull candle, that's my discount. I'm looking for a short now. I'm not looking for a long.
Okay. Couple of other. Oh, right. So Jason did clarify that green candle was closed, but anyway, it's a bit too late.
Well, I just answered the question. I just answered this question anyway. Look, if a green candle closes, I'm more short than I am.
Yeah. Long. Hey, folks, I'll tell you what, if we get to 30 likes at this point, because we're at 27, we're dropping it down to 30. So we just need 3 more, and we'll see if we can get one of you on here. Hands up if you do want to be that person. Do you consider William Fractal to be good for identifying levels, and would institutions use them? Williams Fractal Indicator. I've only used it.
I'm aware of what it is. I've never used it. I don't really trade fractals. Is it good? Well, what do fractals do? They're going to be at a high. They're going to be at a swing high, swing low, a prior low. I mean, if you can mention Williams fractals, you probably know what a fractal is. Okay, so it could be a 3 fractal, a 5 fractal, a 7 fractal, 11 fractal. It could be a 9. It can be any one of them. Yeah. So it's just really identifying, turning points on the chart. As long as it's, depend what your fractal setting is. You want to see more fractals, set it down.
I would probably say, I'd say the answer based on what I know of your knowledge, it wouldn't be good, is what I would say.
No, I mean, the point being is it's difficult for me to comment on it because I've never used it. But based on experience, would I use it? No.
Yeah. Okay. Yeah. Do you use any indicators? Yes. Right.
Not many. Very few. Very few.
Right. Let's see how many we got now, because we can work out what we're going to do next. How many likes have we got here? 28. We just need 2 more, folks, and then we will pick one of you, or at least invite one of you on to help one-on-one. So hands up if you do want to do that. In the meantime, what I'm going to do, JJ, is jump into the survey results. So give us a second while I try and find them.
Let me just give this guy a fair answer here very quickly. Do I use any indicators? Yes, I do. Very, very few. Okay, but if you're going to use indicators, it's important that you understand the nuances of the indicators. Okay, if you can do that, then you can get very, very good, strong information from indicators. Okay, but you must understand when those indicators are weak.
Okay. Right. Let's jump into these responses here. So, just got to share the screen here. Let's stop share and try and share my screen. Now, fingers crossed it shares, because we had some real problems with this sharing bizzo before. Right, here we go. Right, so we've got 31 of you have filled this in. So thank you very much for all the folks that filled it in. We'll just whack this down to the corner here and get rid of Shabba. Righty-ho. So let's go through these, JJ, and just kind of have a look at what the audience and people that filled in the survey. This is sort of like, I mean, it's not a huge sample size. 31 is quite low, but it still gives you a fair idea.
Yeah, it gives us an idea.
Yeah. So start off with that. How often do you strategy hop? So looking at the data here, we've got. Actually, sorry. Can you guys see my mouse? Can you see my mouse? No, you can't. Sorry, you can see it here. So I'm pointing at my my stream. Yeah, not the thing. Right. So we've got here rare, frequently, only when the strategy is losing. I stick to the same strategy. So what have we got here, JJ? What does that look like to you?
Well, that's saying to me that I stick to, so only a third of the participants actually stick to the same strategy. Okay, so what's that saying to me? If you stick to the same strategy, let's assume it's just one strategy for a moment, right? Then obviously I would say that those people, assuming that they're making money, then they would be disciplined to wait for the setups to come, because they probably understand that the conditions of the market that are suitable to their strategy. In fact, so they might be quite proficient at understanding when market conditions actually change. But 2/3 are changing their strategies at some point. Now, do I strategy hop? Well, technically, you could say I do, because I use many different strategies for many different scenarios on the chart, different situations and different conditions. Okay, but what I'm not doing is getting rid of my existing strategies and replacing them with new ones. I just use one or two different rules, if you like, based on certain conditions. So technically, I strategy hop with my own basket of strategies, but I'm not ditching strategies and forgetting them and going on and trying a new one and find the next holy grail. That I don't do. So you got 2/3 of the people strategy hopping. That says a lot about. Obviously, I think there's a question in here.
It's a problem. It's a problem, right?
It's a huge problem. It is a huge problem, and you need to understand how to address it. What's causing you to strategy hop? Don't blame the strategy. It will never ever be the strategy's problem.
Yeah,
you have to look at yourself, and the part of looking at yourself is that partly knowledge? Why is the lack of knowledge not allowing me to see changes in the market conditions? There's reasons that your strategy will go through a bad patch, but if you can't recognize them, is that the fault of the trader or the fault of the strategy? It's really time to look a little bit closer to home and be honest with yourself and just say, well, hey, maybe I do need to know a little bit more. Maybe I do need to recognize when to be more proficient and when markets are changing. As an example.
I think the other thing is, like, the strategy being dynamic does allow you to not feel the urge to strategy hop, because it's, in a way, like, I mean, it's quite hard to describe, but you're using the same tools across all the different time frames, and you're pretty much covering every aspect of the market. So there is almost like no strategy you don't know, because of the way you've structured things. You kind of know everyone else's strategy, so you don't need to strategy hop to a certain degree.
No, I'm obviously where I know I have a slight advantage over many is and as you know, Cam, when I look at a chart and I'm there to place a trade, I'm mindful of what the institutions are doing, what the chart is telling me, what the retail traders are doing. I'm mindful of that before I actually place my order, whether it's a limit order or a stop order or a market order, wherever it is. I'm seeing what other people do, where the orders, because it's what they are doing is where the orders are. And it's only the orders that move the market. No orders, no market. There's no orders on a weekend. The market doesn't move. So it's all about what is driving the market. I'm not going to get into order flow and all these fancy different things. It's about orders. That's what they are. The orders will make your trade work, or they will make your trade fail.
Right, let's dive into the next one here. So on strategy hopping, this is where it sits. It's actually the least of the biggest challenges, right? So the most people have this as a problem, but it's the least of all the challenges.
Okay, let me add to that. Is whether you recognize it. There's a difference. How many people actually recognize it to be a big problem? Well, you got to fully understand it before you can recognize that it's a big problem. Go on.
Well, the thing is, I suppose it's a problem, but people don't see it as their biggest problem, right? So I suppose the question is, should it be their biggest problem? Is a question for you.
Should it be their biggest?
Outside all the other things.
Well, they're all interlinked when you think about it, right? Because if you're getting burnt psychologically because your strategy is taking, your equity curve's going down, you might have winning streaks and then you get a losing streak. And it's much easier to trade when you get a winning streak. When you get a losing streak, that's when you start second questioning. That's when you're starting to get the psychological issues. So they all interlink. They're all a part of the overall approach. So yes, they're all important. And they all need to be addressed in their own way. So let's say if you want your psychological issues to reduce, then address strategy hopping, because strategy hopping causes you psychological problems. So you need to address the root cause. So discipline is a root cause, right? They're all root causes, so they all have room to be addressed. And the more of those that get addressed, the smaller that section there at 22.6% actually becomes. So they all need addressing. They're all important in that in that factor. Adapting to market conditions. To be honest, I mean, there's not a large audience here, but to me, that is a huge problem. But it's not showing as a huge problem. Now, for somebody to actually count that as a problem here, they really need to understand how much of a problem there is, or is it a problem? Let me give you an example. I was talking to a trader the other day that's had a bunch of experience. And I asked him what his biggest challenge was when he started trading. Biggest challenge, technically, I'm speaking now at the chart. I'm not talking psychological. I'm just talking technically now when you're looking at a chart. And he said, well, it's understanding where the market's going to go next. That's the hardest thing. Pick it, call in direction to go next. And then I said, well, you've got a problem. So is that problem down to not understanding or recognizing the market conditions? And he stopped and he thought about it and he looked at some charts and he came back to me. And only then, after chatting for another sort of 5 or 10 minutes, and we went through this quite deeply, did he realize that adapting to market conditions was not just a problem. It was his biggest problem. But he didn't understand it 15 minutes before when I started talking to him about it. He didn't even know it was a problem. Yeah. I'm just throwing that out. Throwing that out.
Yeah. It's a tough one. I mean, because and depending on what time frame, these things can change pretty quick. Right. So the next one was where are you at in your trading journey? So doing well was the smallest there. So only one person said they were doing well the whole lot. So making a little bit. 35%, not making but not losing, consistently losing was only 16%. So, I mean, it's interesting there. It kind of matches industry statistics there around people
pretty
doing
much.
well is quite small. It seems like everyone else is basically breaking even or scraping it a little bit out, but not killing it. So Seems about
So,
right.
so I'm wondering there, when you look at the yellow section there, you're making a little bit. All right. I mean, that's not a bad place to be, because at least you're making a little bit. You might be having some rough patches, you're followed by some good patches. I understand that. But overall, you're making a little bit, which shows to me that those traders have progressed in their journey. Okay, they are moving forward. Now ask yourself the question. Can you just hold that line just 2 seconds, Cam, please? Sorry
Yeah,
about this.
I'll just mute you for a second. All right, I've just muted JJ. Yeah, it's I mean, funny. I was going to say, like, the I suppose progress is, you start there, you get there, then you start making a little bit, and ideally you make some kind of breakthrough over here to doing really well out of it. But it is that progression, and you're going to get stuck in. I mean, this is a big area to get stuck where you just break even. That's pretty good when you're consistently making a little bit, because then it's just a case of scaling and possibly doing something a little bit differently to get you there. That's going to be the experts at the end. Let's see if JJ's back. I'll unmute him.
That yellow section. Sorry about that. The yellow section there, as I was saying before I got interrupted, was it's not a bad place to be, because they're making money, right? At least some money. Okay. Now, how much of that is to do with being too rigid? That really interesting.
Well, I mean, if you look at Ali, who was on the show last week, so he showed us his strategy, and he said he was making 0.5 R a month, which is
0.5% a month.
0.5% a month, right? 0.5%, which is really low. You still managed to. I think he said he had passed funding challenges with that, but it had taken him forever to get there. And by the time you get there, it then becomes like, now I can actually start making some money. But it was never going to be that much, because you're making 0.5% a month. I mean, geez, you can make 0.5% a month in a bank, right? Almost, or some other kind of medium. So you probably don't want to. If you're making 0.5% trading, you might be doing something wrong, or you're working for a humongous hedge fund. So yeah, I think that's where you want to get to, is obviously the doing well from it. Let's move on to the next one. How often do you get stopped out not long after entry? So this is really the question is, you've just entered straight to stop loss kind of thing, versus just entered, a little bit of profit, draw down a bit, maybe a bit more profit, and then you get stopped out, that kind of thing. What have we got here?
Okay,
often's 29%, 54, and then we've got
so 84% are suffering from it, to some degree or another, right? Rare. I mean, that happens. That can happen to the best of traders, of course, right? So that's clearly an issue. Ask why that is. What made your trade go wrong? You jump in, you just went short. Like I said earlier, the market goes a few pips, comes back up, stops you out in the next candle. Why did you get stopped out? It's because you didn't see the orders that were right in front, in your path. 3 pips in front of your path in this scenario. You didn't see them there, but they were there. And it stopped the market, and it pushed it up enough for you to get stopped out on the next candle. Everybody complains about, that happens. And then the market goes back, and your direction was right. You got the direction right, but you got stopped out first and you weren't in it. And the chances are most people would be reluctant to go in a second time, because they've just got burnt. And that affects them psychologically. That they see that as a bad event. And bad events will come back and haunt you in the real world. It's not the good events; it's the bad ones. Okay, and we naturally, as humans, associate a losing trade as a bad event. So we're reluctant to go back in a second time. But the point here being is, this is telling me that traders either do not, or they don't know how to assess whether their trade is high probability or low probability. In this case, there was no scope in the trade. He might have had a 5 pip stop loss, 10, whatever it was, but the scope of the trade was only 3 pips, because that's all the market went. and then went back up and stopped you out.
Yeah, and it's kind of been like a scenario around the losing trade video series we did, where every single one that we looked at was exactly that. They trading basically straight into a bunch of orders that most likely the institutions are placing. And then
exactly.
Stop that straight away.
You can invite any of the viewers to go and watch. Was it one of the last videos with Ali's strategy, where he was shorting right on top of where everybody else was going to go long, because he didn't see the orders. What's the next one?
Shaba's saying, "Come on, guys, we need 2 more likes here. That's all we need." If you haven't liked it, do it for Shaba's sake. Right. How often do your trades not reach target and you give the profits back? So this is a common problem, I think. I think it's a common problem, and this tells us that it is a common problem because we got, once again, the same. I think it's exactly the same percentage as the previous one. It is, although it's a little more and often. It happens all the time to me, where you got your profit target and it just doesn't quite get there.
Okay, so why? But why didn't it get there? What stopped it? There's only one thing that can stop it. That was orders against your position. Nothing else stopped it. But if you don't see where those orders are on the chart, then how can you protect yourself against that? It's inherently difficult, or if not impossible, right? But yet this is such a huge issue. There's 84% of the participants here that's struggling with this to some degree or another, with it not getting to target. And it begs the question that the 16% where that happens rare, I'm probably guessing a strategy there are not multiple R, they're not big targets. Because think about it logically. The further that you need the market to go to reach your target, the less likelihood it is going to get there, because there's going to be more barriers between where you entered and where your target is. Okay, so if you can learn, study the charts and see where orders lay, that helps with so many of the issues that the traders are actually facing and having to deal with.
All right, you're using strategies that are mechanical and rigid. We've got basically 20%, so 80% are using mechanical strategies by the looks of it. Rigid mechanical strategies.
Yeah, but the markets are not rigid. They're dynamic. That's just it. The markets are not rigid. They constantly change. But if you've got a rigid strategy, then you're not changing. You're not adapting to those conditions. So you're fighting those conditions. And if you don't recognize when those conditions change, that's when you probably most likely are going to get your string of losses.
Last question. Last question. Do your strategies factor in how to recognize low probability versus high probability setup? So 60% don't do that.
Do your strategies factor in how to recognize low probability? That's a bit like that stop loss, getting stopped out quickly, right? See, so what that's saying there is 58%, more than half. It doesn't quite ring true with the stats from the 2 questions before. I'll point that out. So you've got almost 60% are basically, let me put an analogy to this. It's like crossing the road, but you don't look left and right before you're doing it. But 58% are doing that. They're not looking left and right. To me, that's crossing the road with a blindfold and earmuffs on.
It's just because I think the people just simply don't know this, don't know what it is they're not seeing.
Right. They do, of course. First of all, you have to be able to recognize it. But even before that, you need to recognize that it's a problem so you can address that problem. Okay. You need to find a solution to that problem. Look at the charts. Look at your losing trades. The next time you get a losing trade and you get stopped out quite quickly, or you just get a losing trade, there was orders there that pushed the market against your position. They weren't put there at random. They were put there for a reason. And the institutions that are putting them there are looking at the same charts as me and you. They're looking at exactly the same data with a slightly bit of broker difference. I get that. But in the main, it's almost identical data. You know, a low is a low, a high is a high, a pullback's a pullback. We're all looking at the same data. So if the institutions are not placing their orders there at random, they're doing it for a reason. Now, it really doesn't matter what the reason is why they want to place their orders right now. You don't have to concern yourself with that. What you should be doing is studying the charts and determining where they're putting their orders. And when you're a proficient at that, that's when you can effectively say, I'm not taking this trade because it's right on top of a bunch of orders and I don't have scope. There's no scope in my trade, or there's only half an hour scope in my trade. Let's wait for that order level to get hit. Wait for the market to bounce back up, and then get a short, and then take it when those orders have been consumed. But obviously, you need a good understanding of that. And to me, reading price and reading price effectively, where the orders are, play a huge part in that.
Righty ho, folks. Well, that is the that's that survey results done. Next thing we were going to do was look at some key levels. Now, what we're going to do this a bit differently because unfortunately JJ's screen sharing was not playing ball before we did this. So what we're going to do is I'm going to do the background work, and we're going to see if he validates it. So does somebody in the audience want to just give us a random market? And what I'll do is I'll try and pick a daily level that I expect price will likely bounce from in the coming, well, let's say today, assuming that it hasn't already hit, which could be the case. So somebody in the audience just chuck a random pair in. Could be Forex, could be something else. US tech, so that's like Nas. Let's see if I've got that handy. I think I've got it in my Nas. Where is it? Have I got it here? Well, it's not handy. I'm just going to have to load it in. All right, I'll have to load it in. What broker are we talking about? Not broker, sorry. Well, let me just find it. So we'll do it as a US tech. So that's not coming up as US 100, yeah? No. I'm just going to go all US 100. Is any other one? Anyone else chuck anything in? Yeah, NQ. Okay, right. Okay. Daydreaming traders gold. I've got that. So let's just do that because this other one's not coming up for whatever reason. Let's just do gold. So we got gold. I'm gonna let me share my screen. So we've got 29 likes, by the way, folks. We need an extra couple, or one at least, before we said we're going to do this thing. So let me share my screen here. And let's just get this ready. Right. Okay, cool. Right, share my screen. I believe it's that one there. Okay, cool. Right, we got it up here. So gold. So we're going to do, that's the daily chart there. Okay, right. So gold, I'm going to do some quick analysis to work out what I think. And JJ's going to sort of, if you've got a chart there on your own screen, JJ, do you want to just
I've got that chart.
Okay, right. And I'm just going to have a look on here and see what I can work out in rapid fire time here. Okay, right. So straight away I can see like a level that's looking pretty solid. Hopefully this is the same. Yeah, it should be the same thing. Okay, right. So I think right. what I think, so my level for today for a potential bounce, assuming that like this isn't, don't trade this blind. This is kind of where we this is where we would I would say we got a chance at this level here. I think we can get a bounce there, even though we've got such a strong bear going in. We could have a bounce there. Now I'm going to do one above as well, so it could be on either side. It has made a move down. It's made a new low. So if anything, I'd expect, just at a guess, I'd expect it to come down, probably do some kind of reaction there. Not a lot, but then I would expect it to either come back up and then move down, or it's just going to do a little bit of a reaction and move down. Because this is such a strong move down, there's a chance that it could just blow through this. But I've got a good feeling that level could be pretty solid. Let's say if it didn't go all the way down there, where do I think it would go to? I think it may have already been there and done the job. But if it was going to go any higher than it's currently gone, if it was going to go any higher, I'd probably be looking at this level here. JJ, what do you reckon? Have I nailed it? Have you done any work on that end?
There's a little bit. Yeah, I've done a little bit. Yeah. Okay, so the lower level there, the lower of your two levels. Okay.
Well, there was one. I did actually think it could be a little bit higher, but I wanted to go with that one because I didn't do the other
fine.
one. Yeah.
That level is fine. Now, would I trade that with a just blindly put a limit order level on that line? No, not at all.
Yeah, exactly.
And that's not my approach in trading anyway. What I'm going to do is if price comes down to that level when it's very close to or touching that level, I'm going to see what the price action is on the very, very low time frames. I would be monitoring more than one time frame: 1 minute, 2 minute, 3 minute, 5 minute, 15 minute. I monitor a whole bunch, right? And I'm going to see what happens there. And if I see strength to the upside, weakness to the downside at that level, then definitely I'm going to be looking to get in. I'm going to be looking to get in for a long. Definitely, there is nothing at all wrong with that level. But if you were going to say to me, well, what's the likelihood of it bouncing from that level and going 500 pips, 600 pips? I'm going to say to you, far less likely than what it would be if you were prepared to trade it on a lower time frame and go for a smaller move, but still get yourself potentially multiple R, right? You only need a small bounce at this level on this time frame to be in a little mini 1 minute trend, for argument's sake. You can get multiple R very, very quickly if you time your orders, if you time your entry well. Okay, you can have a tight stop loss, kind of like under the low of on a 1 minute, and you can trade that move on. So back to what I said earlier, the less that you're asking the market to go in your direction, the more likely it is to get there. So timing entries based on that alone is quite important when you think about it. If you can time your entry well, you don't need the market to go a whole bunch of pips for you to get 2 or 3 hours out of the trade. You only need it to go, relative few, 10, 15, 20 pips, whatever, depending on where your stop loss is, of course. All right, so that
can I redo my other one? Can I redo my other one?
Yeah, and I don't think it's a bad thing if you do.
Yeah, I was just looking at, now I had a little bit of a chance to think about it and less pressure. I was actually going to go with about here, actually. It's kind of like a bit of a guesstimate, but yeah, around about there. I'll probably go, actually here is where I'll go.
Here is where you
that's where I think it would probably, if it's going to go up any higher, that's where I think you could expect some kind of rejection from.
All right, okay. If you can do me a favor and we touched on trend lines earlier. So let me just show you an example here, right? I can't do it because I don't have control of your screen.
Actually, sorry, I'm looking at two screens here. So now it might be a little bit higher. I might be a little bit higher, but yeah.
All right. So you're going there. Okay.
Yep.
And let's see if we can get a bit of confluence to your level, right? So here's what I want you to do. About 15 candles before, you got a very, very large bear, right?
This one here, yeah.
Yeah. Draw a trend line from the top of that to the next high to the right.
Trend line. Damn, I don't use TradingView very often. Come on, this trend line. This is all we have to do. From there to there. This.
Yeah. Now duplicate that.
Yeah.
Okay, and keep going, keep dragging it down. Keep going. Stop. Right in the bottom of that ball there. All right. Okay. All right. So we're actually at a lower level there. Okay.
Yeah.
You can actually see technically what's going on there, right? So there's a chance that it won't get to your level.
Yeah, I know. Yeah, I was trying to pick something that was, because I thought that would have been my level anyway. Well, not that necessarily that one exactly, but I would have been at that level. But I feel that that's already been hit. So I was trying to go, if it was going to go any higher, which it may not, it may not, we don't know. I probably would have gone with the level I've picked there, which is actually, I think it's about right. I think it's about where I would go. If I was going to try and get a little bit more of if it kept pushing up, that would be my next time to try and get in. Similar concept. It wasn't quite the same as yours though. Similar.
Hey, it's similar. What I try to do where possible, it's not always possible, is and it's a part of the reason I asked you to draw those trend lines, was let's just assume for a minute that trend line married up exactly with your level and your reasoning, and there would be confluence there, right? We didn't quite get it. Okay. We didn't quite get it. If you look way over there on the right hand side of the chart where the horizontal line that you drew meets with the trend line, that's confluence, right? So the moment you get that now becomes a stronger level, right? There are more reasons for orders to be there, it was going to make that more reliable.
Yeah. And it's interesting, because that there, mirroring that there that's kind of like an invisible level for most people, right? Because most people aren't going to be able to see that because it doesn't kind of exist.
Well, exactly, but it exists to experience. I should imagine that experienced traders, ones that have been around for a while, who are profitable, would know this. What I asked you to draw there, right? They would know to draw this. Okay. If you see for the people who shoot, and as many people out there do, right? They shoot trend lines down. Why? Because they don't get any success with them. Why? It's probably because they don't really know what they're doing that well with them. So rather than look at themselves as the issue with them drawing trend lines, they blame the trend line, which is a typical trait in trading right the way throughout. Nobody, new traders, no, the issue isn't me, right? Ego gets in the way. No, it's a terrible strategy. That's why I get in a string of losses. Truth is, most strategies will make you money if you know when to use them. Yeah.
Let's jump into another one and see if I can just see what else people have chucked in here. So NAS 100, I just don't have. What is it? German 40. Okay, let's go German 40. I haven't looked at. I think that's in here. I think I saw that. No, it's not in there. What the hell? I think I saw it in this one. DAX. It's not the 40. I think that's the 30. DAX index. I think it's the 30. That'll do. That'll do. Right, we'll just use this one. Now, I don't trade this by any means. This one is like a very choppy from what you're used to in the
you couldn't pay me to trade that.
Yeah, it's like I look at, in all honesty, I look at that and go, it's just so like hard to trade that. It is hard to trade that. Albeit, I don't know what feed this is. If this is it doesn't really say what the feed is. Yeah, I don't know what the feed is here. Let's see if I can. Let's see if I can find. Yeah. So this is very hard because every day it's gapping massively, right? Every day it's gapping massively. It doesn't leave you a lot, in all honesty. Like this is just like computer paper kind of thing back in the 80s. So I would probably just avoid that. I'm sure there's like a better feed of that, which is easier to read.
Well, a lower time frame, you're not going to. Does it have to be daily?
Yeah, low time frames. I suppose we could go. It doesn't have to be daily.
Let's go to like.
Let's go 1 hour.
Obviously, it's going to gap every 24 candles.
Yeah,
right?
yeah. So 1 hour. Okay, let's just look at 1 hour anyway. Let's just look at 1 hour and see what we're going to do here on 1 hour.
Yeah.
So let's just have a look. Right. Okay. Sorry, I'm just setting things up, folks. Have we got the 30 likes yet, guys? Can we chuck it in the chat if you have? Let me know. Right. Okay. So yeah, I mean it's pretty okay. So if this is the end of the hour, it's obviously the end of the day, right? So we're going to gap. We're going to gap when it opens. I don't think this isn't live, so we're going to gap when it opens. Right. If I had to like go, where are you going to blindly fade this? Then when it opens,
A totally different chart.
I would be. You got a totally different chart, have you?
Totally different. I don't even know if it's the same market, mate. I've got DAX, so I just got D30.
Yeah, I think this might be futures. I don't know, but anyway,
and this just looks totally different.
This is probably where I would be looking to get in. Okay. And it might, who knows, it might gap and close up here or start up here, or like it could do anything, right? So the gaps and the unknown.
Well, yeah. Okay. You
wouldn't be trading this time of day.
Okay. Let me add something to that. All right. So you've drawn that line there. So you're assuming now that if this closes as a bear candle, the current candle, and the market comes back up, this is where this line.
Hang on, mate. Hang on. I'm gonna rejig to I'm gonna rejig to here. I'm gonna rejig to there.
All right, I'll start again.
Yep.
So you need the current candle that's printing to close as a bear, right? Correct.
I think it has closed.
Or closed beneath that yellow line.
It's closed. It's closed because the market's not open until 9 p.m. tonight on this chart.
All right. So because it's a market that gapped, it could gap above that line.
Yep.
It could gap below that line.
Yep.
If it gaps below that line, then you've got that line there to say, okay, that's where I would be looking at getting in the trade.
Yeah.
Correct.
Yeah.
Okay.
So it's very hard with this. Like you would not be trading this until you saw the gap, basically. Right? I wouldn't be doing anything until the gap had been done, and then you can start trading that day.
Wait to see the gap first.
So reality is, I'm doing this blind here. That's why it's so hard, because the gap could, like, where's it? So that gap there just gap down, and all of a sudden you've got a different. This is why being dynamic, so I suppose, so important. You got a whole different ball game, right? As soon as that gap's down, things have changed, and we don't know where this is going to get to. As soon as that gap down, things changed. As soon as that gapped up, it all changed again. So
it can change it. So the good thing about being dynamic is you can understand that the market conditions can change in just one candle. So if the market gaps up now and closes above this line, okay, then to me it nullifies that line for short. So conditions have changed. They changed in the gap. They changed in one candle. Literally. Okay, so obviously being dynamic, when you're aware of these things, then you can adapt accordingly, right? The conditions have changed, and just in one candle. So where the close of a candle actually occurs can mean that a market's broke out. It hasn't broke out. It's in a range, or it's broken out of a range. For example, that means something. So just where a candle close can make the conditions of the market change. So there's nothing wrong with your level. I would look to trade that level myself if the market didn't gap above it, and the market comes back up to that level. Okay, what do you want me to add any more into that?
Oh no, yeah, please do. Yeah, I was just going to move on after we've.
Yeah,
finished.
You need to share the chart so I can see it.
Right.
Okay, so just draw a trend line from that sort of high that where your mouse is. Yeah, draw it from there and down, right? Okay, that's it. Now duplicate that line and put it on the close of the prior bull.
Yeah.
Okay, so I'd be looking to trade off any of that.
Yeah, so you got your confluence here.
You got confluence there right now, right?
Come up there. Yeah, it's going to come up there, and
Okay, so I'd be down on I'd be on a low. Price comes back up to there. I'd be on a lower time frame, and I'd be looking to short the market.
There you go, folks. All right. Well, look. Let's have a look at these likes. See where we got to. Where did we get to here? Trying to get my. And I'm getting the likes is one thing. Have we got actually anyone who's interested? I'm sure we got to 30. Come on, guys. Come on. Yep, we got to 33. Okay, right. So I haven't read many of these comments here because I'll be doing this, but who does anyone want to come on and join us for literally get your microphone going, and what we'll do is we'll get you on board and just tell us your problem, basically. What is your problem? And we'll see if we can help answer you. So what I'm going to do, folks, is chuck the link in the chat. So you're going to be joining. Make sure you got a microphone. Ideally, a webcam would be fantastic as well. And we'll invite one of you on. So away you go. Fill your boots. First one to come on is probably going to be the lucky winner, or the first one with a mic and a cam is going to have an advantage over the others. I've got a funny feeling we're not going to get anyone unless Shaba is still hanging around and wants to come on. So it might take a few seconds for people to get themselves organized. So we'll just wait on that.
Come on, guys. We don't bite.
Well, what I'm going to do, I think, is release the audio of this as a podcast on Trading Nut. So if you folks want to listen to this, then we'll have the audio up. Looking at the time, maybe a 2-part series on the Trading Nut over the Christmas period. So let's see if anyone wants to join here. So you're literally just clicking that link and away you go. I'll give it a go, but have no camera. That's all right, Shaba, but no camera is fine at this stage. So jump on that link, and then you're going to need to enable your microphone for the various things that StreamYard requires you to do. So let's see if you can jump on, mate. 33 likes. Well done, guys. That's fantastic. We got there. We're almost aiming 50, but hang on. We didn't get it. 30 will do. 33 is good. At least I hit refresh and it's 34, is it? Oh, it's 35. 35 now. All right, Shaba. In your own time, mate. No worries. We can wait. Here he goes. All right. The question is, can we hear you? I don't think we can.
Can you hear me?
Yes, we can,
Hi.
mate.
Oh, I can now, yeah.
It's nice and clear. Yeah, nice and clear.
All right,
Thank you
great.
for the
Thank you.
questions. Thank you for the questions. It's been fantastic having those on, and hopefully you got some good answers. Now, how can we help you? Thank you for the questions. It's been fantastic having those on. You might want to mute the YouTube video in the background. That's what I can hear.
Yeah. Can you hear me now?
Yeah, we can hear you. Can you hear
Yeah,
us?
sure.
Okay, right now. Sorry, yeah, but great session, guys.
Thank you.
Learned lots here. So yeah, my problem I have is basically the strategy that I've been using is averaging down, and the problem with that is, you know, I use trend lines, I use support and resistance levels, but when you have a day like today, if the market was really heavy down, you just get killed. So I wanted to get away from doing averaging down, and from what I've seen from you guys, what you do in dynamic traders is that you have a stop and you add to positions. So that is what I'm looking at. So I'm just trying to think, you know, how I can adapt to that, the way you guys do it.
It's understanding obviously the conditions. You know, I've talked a couple of times today about when conditions change, and perhaps we don't recognize that the conditions have changed, and for you to be doubling down and, you know, technically adding to a loser, you really need range bound market for that. Yeah. You need that market to come back and your position overall to become favorable. You know, when you only need to get a breakout, you know, of that range, and the market then goes into, you know, let's say a trend or even just an aggressive directional move, then obviously that's where your strategy is going to fall down. Yeah, as you're well aware. Okay, so it's back to trading. You either pick a condition and stick with and trade within that condition, but you would need, in your case, to effectively know, or to be able to know effectively, I should say, when it's likely to break out of that range and then cause you the issues that you're encountering. Yeah. Okay, so yeah, there are many people that add to positions. Obviously, it's not an advisable thing. I wouldn't advise, you know, a complete newcomer come to trading. I wouldn't be advising them to add to losing positions. They're probably going to get wiped out pretty quick. You know, like I said, you really do have to understand the conditions of the market to make that effective. I do it, but I would prefer not to do it, you know, out of choice. If the market was trending, it broke out, it's gone into a trend, I would prefer to trade that. I'm likely to get a better I'm taking on less risk. So I think in your case is breakouts, perhaps. And I'm just suggesting here, right? If you can understand that a breakout is actually in place, and understanding not just when it's in place, a strategy that will also help you identify when it's got a very good chance of being a good breakout. So let me just give you an example. You've got a trend line. You use trend lines, and let's assume you're pretty proficient at drawing them. Yeah. Mm-hmm. And you get a breakout of that trend line. Okay. I would want to see, if I would, depending obviously what order type you're using, but if it was like entering at market or which I wouldn't advise on a breakout, on any breakout, I wouldn't enter at market. I'm either going to enter, wait for a retrace and enter with a limit order, or I'm going to enter with a stop order, but only if that breakout candle is pretty strong. So I would want to see, let's assume it's a long, I would want to see that breakout candle close pretty close to the high of the range of that candle. I would want to see some commitment behind that. If you're a volume, if you're a volume trader, or for those that use volume, which I really don't use, you can use volume to support and give weight to that strong candle. So you're getting a little bit of confluence in the candle. It's not just strong, it's not just a breakout candle, but the volume is supporting that move as well. Okay, that would put you in a position to be able to trade where you're not necessarily having to double down on your positions. You can just have your stop loss in, and you can manage your trade accordingly.
Well, the
I
thing
mean, I
is,
think like, sorry, man, I was just going to say, I've had a few traders on, like, the likes of Nick Shawn and that, and basically, he's even said on the show, you will blow an account or your account at some point if you're averaging down. I mean, it's kind of the nature of the beast, just on these days like you had today, where everything just goes south and you're going long, and it's the drawdown just gets uncontrollable. So I think it's kind of inevitable. Every single stop loss, kind of no stop loss strategy trader I've ever spoken to over all these years have always had this problem where they get massive drawdown and they can handle it, or they blow the account because of these days. So it's just a reality of trading this way. So you just got to manage the accounts better than managing risk in that case, if you're going to try and survive on a averaging down approach.
I think where I have the problem is knowing when the conditions change. They're so subtle sometimes you just don't realize, because you're
Very
so
true.
engrossed in the chart. And when you actually look at a chart, if it's for example just before news or something like that, everything looks fine. The waves are kind of measured, and then suddenly you'll have a move that just looks within the range that you think it's going to be, but it'll gradually get bigger and bigger and bigger. So it's understanding that. I don't know if you I mean, the way I trade the averaging down, I don't do it just based on trend lines. I do it on like support and resistance levels. So I'll add and space out my ads, and and it's knowing how deep it's going to go. And like Cam said, you're going to blow our account, and that does happen.
Guaranteed, you're going to blow an account. It's the people who trade that way. I mean, you can trade that way. You've obviously traded that way. I think what people fail to overlook on that is the risk management. They'll do that on their main trading account, rather than, let's say, removing 10% of that trading account in terms of the money, and moving it into a separate account, and then trading the strategy you're trading with that.
Yeah.
Then if and when it does go wrong, you've only lost 10% of your trading capital, but you've had a chance with that 10% to maybe double or treble it. And if you double or treble it, you should take the 10% you originally took out and put it back in your main account. But don't double down with your main account. When I double down, I will do it in a main account, but I won't. My position size by comparison will be small than if I was trading, say, a breakout move, or I'm trading with trend. So I might look at it and say, okay, I'm going to double down, but I'm going to double down an absolute to a maximum of 2 or 3%. And I might go 0.5% each time I add. So if the whole thing goes wrong, and on occasion it will, then I'm going to lose a very small part of my account. When you're doing it where you're not using stops in the market, and you keep adding, a bit like, say, Nick Shawn, and I'm not knocking the way that he trades. I'm never knocking the way anybody trades. It's their call. Risk management is absolutely key to the success of trading with that. And you've got to take the knocks along the way. You've got to be prepared to lose that account, but you only lose, so you ring fence a bit of that account, and you're prepared to gamble with that. Yeah, that's fine, because to me it's technically gambling. And don't take what I'm going to say to you the wrong way. It's what I call the lazy way of trading. And the reason why I'm calling it lazy is because it's the easy way to trade. We can trade that way and really not have to learn much about trading in itself, and about reading price and looking at the charts. And so and much of what I've covered today means time and effort spent, gaining the knowledge, from the charts, so you can read the chart effectively, which in turn helps you greatly with your decision making. Rather than, it's like when you said a little bit earlier that you don't know that the conditions had changed, or breakouts occurred, or whatever the change was. somebody who can read charts well would pick that up. They would say, hang on, we've got a breakout here, or we're in a pattern, or we're this, or we're that. That, this is what the market is doing right now. And being dynamic obviously helps with that. And where it becomes simple, I can part answer a question that somebody else put in earlier on about simplicity. When you're dynamic trading, you're not looking at hundreds of candles all over the place and back in history. It's here and now. It's what's going on now and around the now. The last handful of candles. I'm not interested in candles way back up the chart where price is nowhere near them, or indicator levels or levels. I'm interested in what's going on around the current candle that's printing and close to. Should it have an aggressive move from there, then I'm going to start paying attention to the other candles and other levels that it's approaching. So really speaking, it is simple because you don't have that much really to think about at any one time. You're focused. You've got a very, very sort of, you could say, I don't know if not narrow is the right word, but to a degree it is, right? It's like you're blocking out all the stuff that's not necessary to you right now. And you're focusing on what is necessary right now, what's pertinent, what's going to make your trade perform or underperform. That is often, and like we talked a little bit earlier on about people getting into a trade and getting stopped out quite quickly. All of these things, they all help by being dynamic. So, and how do you be dynamic? Well, the best way to be dynamic is learn to read price. When you're looking at a chart, it's a pictorial language. It's a graphical language. It's a graphic. That's what we're looking at. And these candles all mean something. They have a meaning. They tell a story. So let's take if anybody's looking at DE30 right now, I'll give you an example. What a 1 hour DE30, if anybody can see that. If you've got a chart there, Shaba, by all means bring up DE30, and I'll just give you an example. Yeah, let me know when you've got your 1 hour chart open.
I'll tell you what, I'll share the screen here and you guys can...
Okay, yeah, you share the screen and I'll be able to... I can't point to it, but I'll be able to describe what it is. As soon as you bring the chart up, I'll be able to describe what it is. All right, so it's a 1 hour chart.
Yep.
You got a different chart to me, mate. Totally different.
That's
why I said DE30.
Oh, DE30. Sorry, DE30.
Yeah, 1 hour.
And you'll be on here, won't you?
Yeah.
Yeah. Okay.
So look at that. Right, about 6 candles.
So it would be almost 4 hour. It's not quite 4 hour with you're gonna probably not get exactly that fill, but let's say you almost got 4 hour and 1, 2, 3, 4, 5, 6, 7 times 5 is 35 minutes. So it's a 35-minute 4 hour trade, that one there. Not saying that was an entry that we were offering, but I mean, that was kind of, that's where he would have got out. Hey, look, I think we're going to wrap this thing up. I mean, hopefully that was useful, Shaba. Do you think
definitely,
you got some
definitely.
use out of that? Yeah, awesome.
Yeah, definitely. I mean, it'd be interesting to see how you guys bring this course together. If are you gonna be teaching this kind of thing, that the bar to bar?
It's definitely on the cards. Where obviously we don't. I mean, it's called the Dynamic Traders Club. The club technically isn't formed yet, and a part of doing what we're actually doing today is to get feedback from people like yourself. I'm happy to do that and teach people going forward, in the future, and come up with strategies and help everybody along their way. But there has to be enough interest out there, from traders to warrant putting the time and effort into it. So it's definitely the intention. So it depends how much support. It depends how much support we get from people like yourself.
I mean, look, to put it into perspective, you would get to learn that kind of level of thing in the club. that's so you'd know, you'd be getting out at that point. This is the kind of stuff that Ali is going through and learning. So you do get that level, but we're kind of looking at variations of how we can get this to people so that it's not too overwhelming in the first instance, and you can sort of, graduate your way up to learning the more sort of stuff that takes a little while to master, only because it's just so much information to take on board in one hit. So we're just kind of working way through things here. But I mean, this time next year, we should hopefully be well underway, assuming everything's sort of, stayed on track and what have you. But folks, I think we're going to wrap this baby up. Anything else here from you two?
Yeah, well, I'll let Shaba go first, and then I'll say something very briefly, and that'll be good. Yeah.
No, I'd just like to say thank you to both of you putting this together. It's been great information and really helpful. So thank you.
Hey, good. No, you're welcome. Just keep in touch with us, Shaba. Yeah. Follow the channel, whatever. Keep in touch with Cam, and Cam is providing regular updates as to where we're at. We're hopeful to have something very early in the next year that you might be able to be involved in.
Okay, thank you very much.
Excellent. Cool. Thanks for your time today, and thanks for the questions.
Thanks, Shaba. Thanks. It's been awesome having you on, mate, and all the best. Right, well, JJ, that's a wrap from us. So I think it went well after the technical issues we had at the very start of the show, and literally, folks, we're down to the wire here. This thing almost didn't happen, but I think you've shared an awful lot of value here on the show, and anyone that stuck around to the end has got 2.5 hours worth of extremely useful trading knowledge and footage that they can go back and refer to. Folks, where to go next? I recommend hitting the link below the video here, or if we put this out as a podcast in the description. We'll put a link there. You got a chance to win this $150,000 mentorship with JJ. We're going to draw the winner in the next few days, so please go there and do that now. And just stay tuned on the channel. Hit subscribe, like, and that notifications bell, and we'll do another one of these sometime in the future. Thanks for watching.
Hey folks, what a view behind me. I'm at Black Bull Markets headquarters here in Auckland, New Zealand. Speaking of views, you can get TradingView paid plans for free at Black Bull Markets, saving you up to $600 a year. Get either the Essential Plus or Premium plans absolutely free. All you need to do is trade from one lot a month at Black Bull Markets. And you can also get a 100% deposit bonus for your first deposit up to $1,000. All you need to do is click the Trading Nut link in the description below. Our sponsor Blue Guardian's the only prop firm that gives their traders a tool to protect them from hitting their max daily loss and over trading. It's super simple to use. Just set the Guardian Protector each day from your dashboard. Did you also know that they've just released an unlimited time evaluation with a 0 trading days requirement, giving you plenty of time to hit their low 8 and 4% targets, making it super fast to get funded. Plus, it's cheaper than the 40-day time limit evaluation. Check out the link and coupon in the description to get 10% off your next Blue Guardian evaluation.